Well, thank you very much for having me. This really is, a pleasure for me. So, what I'm going to try to do today is just kind of go over how we incorporate different asset classes, really to gather information and to find opportunities to really maximize risk versus reward opportunities. I was talking with Yana. She's like, there's a lot of we like to learn about stocks and commodities and currencies and things of that nature. So I'm like, okay, maybe bringing them all together can really add value, to the rest of the presenters. So I hope I can do that, and save your questions for the end. We'll do a little Q&A. So just briefly, a little bit about myself. I founded Eagle Bay Capital back in 2012 for the sole purpose of managing one portfolio, managing a fund for investors in the most efficient way possible. And just recently, we launched our research product, which is a subscription-based service. Really, due to popular demand, I had never really done anything like that. But people have been asking because we manage money, but for only accredited investors. So a lot of investors, either they can't invest in the fund, or some people just like to do it on their own. So we're kind of expanding into a different type of investor, and we're really excited about it. We've gotten great feedback. We'll talk a little bit about it at the end. A lot of you probably know me from allstarcharts.com. I've been writing there for 4 years. When I first started the blog, it's really how I got my name out there, and gotten asked to come on on TV and whatnot, and investors calling me. You can also follow me on StockTwits and Twitter at allstarcharts. I'm in there, sharing charts on a daily basis, and I'm also recently named a contributor to Yahoo Finance. Just for the attorneys, to make my attorneys happy, everything you guys hear here today is not any sort of solicitation of any kind, no buy and sell recommendations. This is strictly for educational purposes only. So I just really want to reiterate that this is not a solicitation, which obviously I think you guys know that. And I'm just going to go over a couple of basic concepts before we get into the actual analysis, just for maybe some of the newcomers, just to show you guys how really I look at markets. This is supply and demand 101, support and resistance. What was support eventually becomes resistance. So in this case, it kind of looks like silver over the last year. So we have support at the red line, support, 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 and then it breaks down. On any kickback towards that prior support, we know that the buyers had dried out, the sellers are now in control, and that turns into resistance. So when we talk about technical analysis, this is the beginning of it all. This is really where it all starts, and it's a very important concept to understand, and it works in both ways. Prior resistance also becomes support. So I just want to really reiterate that concept. The market obviously is not that simple. Mr. Market likes to make it difficult on us. So a lot of times we'll get these failed breakouts out of key resistance. So it's not as clean as something like this, let's say. So in a case like this, you keep bumping up against this level, more resistance, more resistance, more resistance. Then you break out, and then all of a sudden that breakout fails. And a lot of people are worried about these failed breakouts. I prefer to anticipate them. I'm going to show you guys some great examples of these. They really present the best risk reward opportunities, because at the end of the day, the reason we're in this market is not to be right. We're not analysts, we're not economists, we're not journalists. We're trying to make money in the market. So there's no egos here. We don't have to be right. We just have to make money. So when you find these failed breakouts and you can anticipate them properly, the risk versus reward is skewed so much in our favor that it's so important to recognize when these opportunities really come about. Same thing on the other side. Support, 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 it breaks down, then all of a sudden you get the quick recovery back. Really the entry point is when this particular stock, let's just call it a stock, starts breaking out back above that former support. That's your entry. And then your stop is, if we break back below it, you're out. But the stop is very well defined, the risk is very well defined, and the upside can be tremendous because you get such powerful breakouts on some of these moves. Same thing on head and shoulders patterns. Everybody talks about these. They're actually very rare. More often than not, they fail. But you got your left shoulder, your head, your right shoulder, then your neckline down below. Once the neckline breaks, everybody gets excited, they short it, and they hope that it crashes. But a lot of times, the opposite happens. Go back and see the S&P 500 in the summer of 2010. This pattern looks exactly like this. You have a very clean neckline, you have your breakdown, oops, and then it starts creeping back above. Tremendous opportunity, and we've all seen what the S&P did after that. But we see this time and time again, guys. So I just wanted to reiterate a couple of those things price-wise. Now moving on to momentum, I want you guys to understand how I look at this. I use a 14-period relative strength index, which is the RSI, and I use them really in two different ways. The first way is to really define whether a particular stock, this could be a stock, commodity, bonds, doesn't matter. We really treat all asset classes exactly the same. By the way, I use a 14-period RSI. I just want to reiterate, this can be on a daily time frame, a weekly time frame. The market is fractal. So I use 14 periods, and then it adjusts. It automatically adjusts depending on my time frame, whether it's a daily or a weekly or a monthly or a 10-minute chart. So typically, when a stock or a commodity or an asset class is in a bull range and it doesn't get oversold below 30 during market sell-offs, that's very healthy. That's a bullish characteristic. Yet during rallies, it gets into overbought territory above 70. We see the same thing in bear markets, but the opposite. During sell-offs, it tends to get oversold below 30, but during rallies, it fails to get into overbought conditions, which is a very bearish characteristic. So I just want to make sure you guys get that concept. And then the second way I use momentum is to confirm trends. So in this case, we have a downturn in price up at top. At the bottom, we have a 14-period RSI. And you see, when a market's making new lows, you want to see momentum making new lows as well. In this case, it put in a bullish divergence. It put in a higher low when prices were making a lower low. This is actually silver in the summer of 2012. You can go back and check it out. Monster rally, and same thing to the upside. When prices are making new highs, you want momentum to make new highs as well. When it doesn't, on those pivot highs, that would be a bearish divergence. Same thing. It tends to warn of a change in trend, not necessarily a reversal in trend, but certainly some kind of change, whether it be sideways or reversal. And then we use multiple time frames, and I think it's really important to understand that particular concept of looking one time frame higher. So if you're a day trader, look at daily charts. If you're a swing trader or intermediate term trader that uses daily charts, look at weekly charts. So me, myself, I have a daily time frame, so I like to use a weekly. In this case, we're looking at Apple. This is a little over a month ago. Beautiful trend, right? Higher highs, higher lows. Nothing wrong with this chart. Moving averages, trading higher, all good, right? But if you look at a weekly time frame, it's really not that simple, because now here we are running into the 2012 highs. So there is overhead supply here, and sure enough, Apple's gone nowhere in the last month. So if you would have just looked at this chart, you would have said, oh yeah, this is a great chart. Higher lows, higher highs. But if you look here, there's a lot more going on. So I think it's really important to reiterate, look at higher time frames and see what's going on in the bigger picture. This is just a good example that I saw. And then, the reason we look outside the entire world is because we can. So in this case, this is a correlation matrix looking at all of the S&P sectors against each other. The more green that you see on the screen, the more that they move together, the higher the correlation. These are obviously all, S&P sectors, so they obviously move together a lot. Here's the same matrix, but it's 20 different countries compared to each other. There's a lot less green, right? A lot more reds and oranges and grays, showing us that there is less correlation, or none in a lot of these cases, between these countries. So, just from a pure correlation standpoint and having true diversification, this is not true diversification. Oh, I own parent financials. That's not diversified. This is a lot more diversified, in my opinion. And then you start adding different asset classes that are also uncorrelated, and you really truly can set up a diversified portfolio where you have positions that have nothing to do with one another. So we look at countries all across the globe, then we narrow the focus. Where's the strength? Where's the weakness? What do we like? What's doing well? Is there anything that stands out? And then how do we execute that? Do we want to be in an individual position, or do we want to pair where we're essentially long of one asset and short of another? Or do we want to be in the ETF itself, or perhaps do we want to be in an individual component? So that's really how we narrow it down, from the top down, and that's really our approach. So we're looking at all the major S&P sectors. In fact, we have, I'll talk about it at the end, but we have, our major U.S. averages and interest rates package that includes all of these. We all look at the major averages every single week on multiple time frames. So you can see S&P, Dow, mid caps, Russell, NASDAQ 100, Dow Transports, etc. We'll look at the entire world. This is actually our global macro package. Japan, Malaysia, New Zealand, Singapore, Taiwan, Colombia. It continues Mexico, Peru, Ireland, Italy, So we're really looking all over the world. And we also look here in the States. We're looking at, these are U.S. sectors and U.S. sectors and subsectors. Package is just a good example. Gold miners, financials, retailers, etc. So we could really get an idea of where the strength is, what countries have the most strength, what sectors in the United States have the most strength, which of the major indexes have the most strength. A good example of that this year, Russell 2000, small caps, micro caps, they've really been struggling relative to the larger cap names, S&P 500, Dow, etc. So I think it's important to really take a look at that. And obviously, we're looking at all the major commodities. We have a commodities and currencies package as well. Gold, silver, these have been, trading. I mean, these have been incredible moves lately in some of these. Palladium specifically, Sunday night, Monday morning. Wow, what a move. So, it's really important to take a look at some of these. Lumber, for example, setting up structurally, very interesting, I think. And then we look at all 30 Dow components. You talk about Papa Dow. If you can get a good idea as to where the majority of these names are going and whether they're bullish or bearish, you can get a pretty good idea of where the index itself is going to go. So I think that adds a lot of value. We have a Dow 30 package as well. And then the currency crosses. I mean, listen, even if you're not trading these currencies, you could still get a lot of information from them. If you look at the Euro-Yen cross, I mean, back in 2008 when we were trading that crash, if you weren't looking at Euro-Yen, I don't know what you were doing, because that was really the tell. You follow Euro-Yen goes higher, market's going higher. Euro-Yen rolls over, it's going lower. The Euro was the risk-on currency, the Yen was the risk-off currency, so that really added a lot of value to that particular moment in time. And these correlations change, so you really need to, keep running the math and making sure that you're comparing the right assets. And also from a trading perspective, look at dollar CAD, U.S. dollar versus Canadian dollar, looks great structurally. I mean, that's a fantastic chart. So let's just get right into it. I wanted to talk about this right away. A major topic of conversation these days is the U.S. dollar. How now it's bullish and everybody likes it. That's just a perfect example of the way sentiment changes. Back in May of 2012, this is what I was writing, and nobody was talking about the U.S. dollar. Nobody cared about the dollar. I mean, if anything, they're talking about the dollar crashing. Nobody liked it. Sentiment was atrocious. I loved it. I thought we were going to get an epic squeeze for multiple reasons that we're going to go over right now. This was on May the 12th of this year. So here we have a major typical topping pattern. Those new to technical analysis, this is your standard top, rounding formation. As they say, the bigger the top, the bigger the drop. So this is, your standard top that everybody can see. And you have this failed breakdown below both of these trend lines. So, don't be afraid to draw multiple trend lines. A lot of people are like, no, this is the trend line. No, this is it. You know what? There can be two. It's okay. This is an art. It's not a science. So in this case, we drew both trend lines. Both of these made pretty good sense. And they're off. These made pretty good sense. And we got a failed breakdown. That was very interesting, which is, again, a reason that I wanted to show you guys at the beginning, how I really take a look at these markets. Here's a bigger picture look. This goes back to 2012, where you can see this is the U.S. dollar key support. That first low in the fall of 2012. Continued to test that level the last couple of years. There's your failed breakdown in in May of this year. That was your entry point. Also, look at the euro. For you guys that are unaware, the euro is actually the biggest component of the U.S. dollar. It's almost 60% of the U.S. dollar index. So when you have the dollar at that point where we're getting bullish, and then you look at the euro and it's running into a trend line from the 2008 highs, that's a big, big trend line. And look at that failed breakout above the trend line that couldn't sustain itself. So a lot of things are telling us to buy the dollar. Nobody's talking about it. This is in May. Then we look at sentiment. Here we're looking at just an aggregate consensus of public opinion where, we're taking Bloomberg data, Ned Davis data, everybody gets a poll. This is an aggregate of all of them, and the blue line is the actual consensus of the polls, and then the red and the green are 1.5 standard deviations above and below a 1-year moving average of this particular indicator. When it gets below the green, that's a good sign. That means everybody hates it. Here we are in May. Everybody hates U.S. dollars right at the wrong possible time, which is standard behavior for the market. We're always greedy when we need to be the most scared, and we're always scared to death when we need to be the most greedy. That's just the way we are as humans. Those are our flaws. So the most important thing is to recognize we have that flaw, and now that we recognize it, let's take advantage of it, right? So here we are. Human emotions are really, telling. The human emotions are saying, be scared about the dollar. But when people are the most scared, as you can see in this chart, is really when you need to be the most greedy. And here's what happened. In May of this year, that was the buy. And speaking of epic squeezes, we got a monster squeeze in the US dollar. So again, it's really bringing it all together. What's sentiment telling us? They hate it. What's the euro doing? It's a big component. The euro looks bearish. If you go back and you look at this exact same sentiment indicator for the euro, everybody loved the euro. Again, at the most wrong time humanly possible to love the euro, when you need to be selling it. Because look, here's what the euro did. Everybody loved it up in May, and then it crashed, and now everybody hates it. Obviously, if you look at the sentiment data now, everybody hates the euro. And sure enough, they love the dollar. This is pretty current. This is about a week old, maybe less. Everybody loves US dollars now. Why do they love it? Because look what it just did. But they hated it before it did that. You see that? They hated it, and now they love it. And that's the flaws in our human emotions. We're inherently flawed. So we need to recognize that we have that and really try to take advantage of it. That's the market. That's market behavior 101. So moving on, I think this is a good example of kind of taking a look at emerging markets as a group. Here we have the BRICS, China, Brazil, Russia, India, and then in the light blue we have emerging markets as the entire group. This is a chart that goes from September of last year to March this year. And the reason I wanted to show this is because, when I was running through my analysis at that particular time in March, India was really standing out, guys. I mean, really standing out. Look at this chart. You got all of these emerging markets down. Brazil getting clobbered. Russia, terrible. Even China, emerging markets as a group. Meanwhile, you got India making new highs. So the market's speaking, like something's going on in India coming into March of this year. So here's India itself. Here's your key support level, just under 16 bucks. It's pretty clear. And then what happened last fall, we have a breakdown below that level. Again, another reason why I wanted to show you guys this at the beginning, so you guys really get the way I look at these markets. We have this breakdown at the end of last year. And now all of a sudden we're breaking out above the downtrend line that goes back all the way to essentially the beginning of 2011. Guys, there's something going on in India coming into March. So here's India relative to emerging markets as a group, really doing that intermarket analysis. You have that key support. Again, the exact same thing. Failed breakdown in the second half of last year, quick reversal back, and now we're taking out the downtrend line from 2012. So on a relative basis, it looks good. On an absolute basis, it looks good. Compared to the other emerging markets, it looks good. What is going on in India? Meanwhile, Russia's breaking down from a failed breakout, while India's breaking out. So let's compare India to Russia. Sure enough, in the second half of last year, failed breakdown below support, and now we're breaking out, not only above horizontal resistance, we're breaking out above a downtrend line from 2009. So a lot of things saying as terrible as Russia was, India is looking great on itself and on a relative basis. So that's where we want to be. When you look at any emerging markets, we want to be in India. India was up 35% over the next 6 months. I mean, the market was speaking, so we should not be surprised. Now, you don't just have to buy India. Once you get a theme, or the India ETF, in this case EPI, once you have a theme where, hey, we want to be in India, there are other ways to take advantage of it. In this case, here are the Indian small caps, essentially the Russell 2000 of India, and it was up 75% during that same period. So depending on what your risk tolerance is and what your time horizon is, and what your goals are really, there are multiple ways to take advantage of that. There's nothing wrong with 35%, but if you want to really get aggressive and speculate a little bit more on the smaller cap names, you definitely were handsomely rewarded. And here is that same performance over the next 6 months of India up over about 35%. Russia and the S&P up single digits during that time frame. The market was telling us that something was going on in March. You know, we like to listen to the market. The market is the smartest out there. Forget the news. Forget what the analyst says. You know, forget what the economist says. None of that matters. The market is a forward-looking indicator. The economists are looking at backward-looking information, and the market is forward-looking, 6, 9, 12 months in anticipation of what's going to happen. Now everybody loves the dollar, and they're worried about you know, how that's going to affect the earnings. Guys, we know the dollar's up. We know it's going to affect the earnings. Stop pretending it's a secret. We know that the stronger dollar affected the earnings. That's already priced in, guys. The market is a lot smarter than a lot of people think. So just, sorry, guys, it makes me chuckle. All right, so moving on. This was another great example of a sentiment unwind. I mean, to me, you know, one of the most fascinating things of 2014. You know, I get excited just talking about it. This is the Consensus Inc. Sentiment polls of Treasury bonds coming into 2014. This is published by Barron's every Saturday. You know, it really gives an aggregate consensus of how people feel about bonds. So this is the percentage of bond bulls. As you can see, coming into the year, there weren't any bond bulls. In fact, speaking of economists getting it wrong, of 67 economists, okay, coming into 2014, all of them said interest rates are going higher. 67 of 67 economists said interest rates are going higher. Okay, I'll take the other side of that all day. So in this case, the market is telling us the same thing. Everybody hates bonds. So everybody hates bonds. Why? Because they think interest rates are going higher. For you guys unaware, interest rates and bonds trade inversely. Interest rates go up, bonds go down. Interest rates go down, bonds go up. So economists say sell bonds. The regular public investing community, they say sell bonds. Okay. Here are interest rates running into major downtrend line resistance. Just when the economists, who are not market participants, they just like to look at backward-looking information that is constantly getting adjusted, by the way. So whatever data comes out, they're going to change it like 10 times in the next year. So the point of looking at that information is beyond me. So here we are, interest rates are running into this trend line just at the time where economists are saying interest rates are going higher. The market is clearly telling us otherwise. Notice the bearish divergence in momentum down below, you know, as interest rates are running into this trend line that economists say is going higher. Here's just a closer look. There's a bar chart of the 10-year yield. As you know, coming into the new year, we got a quite little bump up. You know, the economists are getting all excited because rates are above 3, so they're all pumped up. But look at momentum. How in the new high in December, momentum never hit overbought conditions. You know, so that was a bearish divergence, and another reason, you know, not just because the economists loved it, but the market is telling us that, you know, to get away also. So now that we know that everybody thinks that bonds are going lower, you know, everybody thinks that the interest rates are going higher, let's see what the market is doing. Here's a downtrend line of TLT. This is the U.S. Treasury Bond Exchange Traded Fund. Look at the failed breakdown coming into the year. I mean, is that not a beautiful thing? You got a failed breakdown below support, and now all of a sudden you got prices breaking the downtrend line, very similar to what we saw in India. So everybody hates bonds. The economists hate the bonds. The public hates the bonds. I love them. Look at momentum putting in a bullish divergence, now breaking out above this downtrend line. I mean, what is there not to like about this chart? And by the way, the most important thing that I really want to reiterate here is that as market participants, we don't have to be right, okay? There are no egos here. This is only about making money. So let's say hypothetically we were wrong on this and the economists actually got it right. The stop loss here is that gray shaded area. We break back down below that gray shaded area and this breakout above the downtrend line failed, all bets are off. Guys, we got it wrong, we'll move on. Like, no big deal. There's like a zillion markets out there. So I'm not just showing you guys this because it worked. I'm showing you guys this because hypothetically, if it didn't, it really wouldn't matter to us because the risk was so well defined. So I just want to take that moment and just reiterate how important it is to recognize that we don't need to be right. It's not, hey guys, it's coming back, don't worry, you know, Chinese PMI or whatever. No. The risk is very well defined and we need to be disciplined. It breaks back below the gray shaded area, all bets are off. That's the best part about this trade. Obviously it worked, and Treasury bonds have done nothing but explode all year long. and interest rates have done nothing but crash the entire year. So when the economists that look at backward-looking information are telling you rates are going higher, we like to look at forward-looking information telling us rates are going lower and we need to be buying bonds. That's why we look at the market and we don't worry about the nonsense that is quote-unquote the news these days. So I want to show you guys, our seasonality model and really how we incorporate that into the market. So we put together, this is a 1-year seasonal model that goes back to 1928, that tells us the percentage of the time that the market is up in any given month, and also the average return in any given month. So we can get a pretty good idea as to, how we want to be positioned, whether we want to be more neutral. That I think is really important. Then we take a look at the presidential cycle, the 4-year presidential cycle. So you have the post-election year, you have the midterm year, which is this year. Next year is your pre-election year, and then you have your election year. That's the 4-year presidential cycle. It tends to struggle the first couple of years and then do well in the last 2. Here is an aggregate of every midterm election year going back to 1930 and the midterm election years. So the seasonal trends are telling us, hey, going into the end of the summer, be careful, it's not a great time seasonally. Okay, the presidential cycle is telling us the same thing. Hey, going into the end of the summer, not a great time seasonally. Okay, and then we look at the decennial pattern as well, just so you guys get an idea. The market tends to behave differently depending on what year of each decade we're in. This goes back to 1886 and gives us the average return of any given year, within the decade. So in this case, we're in the 4th year of the decade. So we look at 2004, 1994, 1984, again, going back all the way to the 1800s. So we know that next year, potentially, we're going to have a huge year. Look at the 5th year, how much that stands out. On average, the 5th year of every decade is up almost 29%, which is tremendous. So we take that and we create what's called a cumulative composite of all 3 of those cycles. And as you can see, the cumulative composite is telling us, hey, be careful going into the end of the summer. Okay. So we know maybe we want to be a little market neutral. Again, there are other factors that weighed into that decision, but seasonality, I just felt this was a good way to show you guys that, because we did incorporate that into our strategy coming into the summer. So here we are in early July, and we see Germany just rocking. I mean, over the last couple of years, Germany was making huge moves, and Brazil, as we noted earlier, was just a disaster. Nobody wanted to be in Brazil. So here's Brazil on its own. Earlier this year, we have a nice failed breakdown there, a nice bullish divergence. Brazil's not looking too bad, again, in July. Well, this is actually back in September, but you you can look back and see where we were in July, and it looked pretty interesting. So then we look at the Brazil versus Germany spread. So this is a long Brazil, short Germany. So long EWZ, short EWG. Here we are breaking a downtrend line that goes back to 2011. And now we have that former support that's turning into resistance, and we're breaking out above that as well. So the particular pair looks good. So we know we want to be equities neutral going into the last 6-7 weeks of the summer, and being long Brazil, short Germany for that mean reversion trade that we're seeing here, essentially having these two, connect back together, because this is unsustainable for whatever the reason. And here we are. We like the chart. What happened over the next 6 weeks? The Brazil-Germany spread was up almost 20%, and the Dow Jones Industrial Average was flat. So we were able to position ourselves in a market neutral sort of position, yet still take advantage of a directional move. And if you guys want to go back, I could show you the analysis in real time. And I think I was on Fox Business on TV talking about this particular spread. The World Cup was going on, and Brazil was playing Germany, actually. I'm not a soccer fan. I actually didn't even know that. So I thought, if I did, I would have mentioned it. But I had no idea. It was just a huge coincidence. So I thought that was pretty funny. And really, that's it, guys. I mean, that's I guess we have some time for questions and answer, but that's really the way it works, and we really incorporate all of these markets into our analysis every single day. So I wanted to give you guys a special. This was only something that we did a couple of weeks ago, but for this particular event for Trading Pub, I felt that we should definitely extend this to you guys. So what this is a special offer that's just limited time only, where you're getting all of the S&P sectors, right? So not just the major 10 financials and discretionaries and energy and utilities, but you're also getting the subsectors. So biotech and gold miners, regional banks, broker dealers. So you're getting the subsectors in addition. You're getting over about 50, 60 charts on that one. Then you have the global macro package, which is really, in my opinion, my favorite one, because you're getting the most charts. You're getting every single country that we look at, from Brazil, Mexico, Peru, Chile, to the European countries, Germany, France, Poland, Italy, Spain, to the Asia Pacific countries, Malaysia, Indonesia, Japan, Australia, New Zealand, Israel, South Africa, Egypt. So you're really getting a good idea of what's happening, all over the world. You're getting this on multiple time frames, once a week, daily and weekly charts, momentum analysis, relative strength analysis, trend pattern recognition, Fibonacci projections, and most importantly, risk management procedures. So, and you also get access to me as well. You can message me anytime. We have our members, and they send me questions, whether it be, hey JC, take a look at this, or hey JC, I'm wondering your correlation analysis. Can you explain that a little bit more? So I'm happy to help, and I think there's a great product. This is almost a $2,000 value. You're getting it for the entire year, and it's less than $1,000. So you're getting basically a 50% discount. So I really want you, hope you guys can take advantage of that. It's vip.marketfi.com/Eagle Bay. Again, just to reiterate, if you guys have any questions, I can be emailed directly, info@eaglebaycapital.com. And you could go to the blog, allstarcharts.com. You'll see, I'm constantly writing there as well. But again, if you can't find something that maybe I mentioned on the webinar, or any questions that you might have on something that I said or maybe didn't say, again, feel free, email me, info@eaglebaycapital.com. Just put on the subject line, Trading Pub webinar or something like that, so I know who it's coming from. And at this point, let's rock and roll. Let's open it to questions. Let's have some fun. So how do we do this question? Are they down there? Are you guys going to ask the questions for me?
Okay, so JC, hey, this is Raleigh here. We have almost about 40 more minutes to go in this section, so we have a fair amount of time on our hands. Folks, please, type in your questions here to JC so that he can address these. Once again, his focus was on showing you how he uses multiple chart time frames and technical analysis to make decisions about the markets. I can see that Jay says, is the dollar short here? And are you asking, in the current time right now as you're watching the dollar there, Jay?
So here we're looking at the dollar.
And I think there's...
So here we're looking at the dollar. And this is a very interesting situation, because we have the parabolic move. This is a weekly chart of the US dollar going back to the downtrend line that goes back to the 2005 highs, and we're above that downtrend line. So as long as we're above the downtrend line, which is also horizontal resistance from these highs last year, there's no reason to be short this, especially when momentum's so strong. It's very difficult to be short this unless we're back below that level. So I wouldn't be shorting it. I just think it's time to be taking profits. In addition, here's a daily time frame. This chart goes back 2 years. Here we could see this is a 261.8% Fibonacci extension, which, if you guys have any questions on Fibonacci, feel free to email me and I'll send you a link of a couple of things that I've talked about in the past. But yeah, we're running into that Fibonacci extension. That was the target. Here you guys can see the failed breakdown. Isn't that nice? And then the essential rally. So to be short this, really depends on your time horizon. If you're a short-term trader, this is a strong parabolic move. So to be short outright, it's tough. But I'd rather be short than long, that's for sure. But again, I wouldn't want to be short above 86.13 on the dollar index. We can take a look at the euro, just to answer your question, because it's such a big component. This is an interesting situation because the euro, as you can see the failed breakout up here, isn't that beautiful, guys? So here you have key support from the 2013 lows. And if we can get back above this level here, there's your failed breakdown, right? And sentiment in the euro is just atrocious right now. They hate it at the wrong possible time. You've got a bullish momentum divergence in RSI. So that's signal number one that the euro could be going higher. But if we take out today's highs, for example, and we're back above that gray shaded area, I love it. But for me to tell you to be short the dollar, that just depends on how much risk you're willing to take, what your goals are, what your time frame is, and I can't answer that question for you. I can tell you what I'm doing and what I'm looking at, and then you can decide for yourself, how much risk you're willing to take, and if that's something that meets your particular parameter. So again, I just want to reiterate that we all have different time frames, we all have different goals, and why we're in the market. So for me to tell you to short dollar would be disingenuous because I'm not really sure where where you are in that spectrum.
Okay, there's another question that came in here. JC was wondering, what specifically do you trade? Futures, stocks, options, ETFs, Forex? Do you have a favorite market, or do you basically look at what's the best setup at the time?
Sure. That's actually a great question. So there's a few ways, once I like a particular theme, as you guys, I hope I tried to express that well. If you guys like if I like a particular theme, there's different ways to take advantage of it and different vehicles. So in some cases, a stock might, let's say we like gold miners, for whatever the reason, and, we have options. So how can we take advantage of the gold miners trade? Well, we could just buy GDX and call it a day, or we could look, or GDXJ, the junior gold miners, for example, or we could take a look at the individual components, maybe a Randgold or a Newmont or a Barrick or something of that nature is stronger than the index itself or the ETF itself. So perhaps owning a particular name over the ETF might be a better idea depending on, what looks stronger. Also, let's just say we want to be in a gold miners neutral position. We just see that, let's say hypothetically, Newmont Gold looks better on a relative basis rather than over GDX. We can essentially be gold miners neutral, own Newmont, for example, and be short an equivalent amount of GDX, be gold miners neutral, yet still have a directional exposure in a gold mining sector. So that's a way where you have to decide whether you want to be in the ETF or the stock or both. In some cases, let's say the gold miners I'm not really sure. Gold looks better. We'll trade the futures or the ETF GLD because GLD is actually a very liquid ETF. So it really depends. The futures for less liquid ETFs are probably better. And then in terms of the options market, it's not, hey, you either trade stocks or you trade options. In a lot of cases, you can trade the you trade the options as a vehicle to take advantage of a given stock. A good example of that was in the treasury bond market. Rather than buying TLT, they get a 15% move in TLT after being so right, might be a little bit difficult to swallow. So perhaps owning an in-the-money call, let's just say TLT's at 100, owning a 90 or a 95 in-the-money call going out a couple of months is going to give you that extra juice. So that I think where a 10-15% move in the ETF will give you an exponential 100-200% move in the individual call option, where your risk is just as defined as it is in the ETF. So, I think it really depends on how you want to take advantage of a given theme, and then decide what the most efficient vehicle to do so is going to be, and that just really depends on the situation.
So along those lines, JC, you were talking and using gold as an example. We have a question here about, so what are your current thoughts on gold? Can you share your gold chart and give us some view there?
Yeah, 100%. So if you guys want to go, if you guys want to go to allstarcharts.com right now, in fact, there's a video that I did on Fox Business yesterday that I posted on there where I actually talk about gold and silver. So you guys can check that out. But in the meantime, here we'll take a look at gold. So here's gold on a weekly time frame. Just open this up a little bit. So here's gold on a weekly time frame. So here we have a symmetrical triangle that is typically very continuation by nature. So when you see these symmetrical triangles, in all likelihood, it's going to resolve itself in the direction of the underlying trend, which in this case, gold is in a very vicious bear market for several years now. So we have a bearish sort of understanding, I suppose, of gold for a long, long time. So sure enough, we broke down as expected last month below the lower of these two converging trend lines. Now, we still have horizontal support from the lows last year. So the market is going to recognize those lows in all likelihood. So to expect us just to crash from there, probably not, probably not going to happen. Crashes don't come when everyone expects it, which is why we look at sentiment. So another reason why we expected a bounce from these levels is because the U.S. dollar is so loved right now. So like I told you guys before, and that's really where the intermarket analysis comes. You guys are asking me about gold. I'm telling you about dollars. So I think that's a good example. So gold and dollars, there's dollar strength. In all likelihood, you're going to get gold weakness and vice versa. Dollar weakness, you'll probably get some gold strength. So if we're fading dollars up here because everybody loves them, in all likelihood, you're going to get a pretty decent bounce in gold. So sure enough, we're seeing it, but I think that you're going to be able to fade this bounce, any strength. I don't even know that we take out, the 1240, but, we could see 1250, 1280 at best. I would fade that. I think we ultimately roll over. The more times that a level is tested, the higher the likelihood that it breaks. I'm going to show you an example of silver right now, but we already tested this level, this 1180 level now 3 times. So where I come from, triple bottoms don't exist. I think we'll get a 4th test here, and then that'll break, and then we'll eventually hit 1,000, in my opinion, which is resistance from back in 2007, 2008. That polarity, right? The first slide I showed you guys. Former resistance turns into support. Again, in theory, so that's where I would be covering my shorts from a structural perspective. And then down below, you have momentum, RSI putting in what appeared to be a bullish divergence that failed. Guys, when these bullish divergences fail, oh man, these markets are really in trouble. So I think there's a lot going on here. I think this bounce is normal. It should be expected, but I think you could fade that bounce. Now, looking a little bit shorter term, again, multiple time frames. Here's a daily chart going back 2 years, and where did the market stop declining, right? The market stopped declining after this long crash. The market stopped declining at the horizontal support that we saw on the weekly chart, right? Support from last summer. Here's your first bottom, your second bottom. This is the third. But this is also the 161.8% Fibonacci extension from the most recent rally off the summer lows. So you take the entire move, and then the 161.8% extension takes us right here, just under 1180. So, the idea behind Fibonacci is that when these levels coincide with other support and resistance levels, whether it may be a moving average or former support and resistance or whatever the case may be, that's really where we really want to start paying attention. We don't just want to blindly be buying and selling based on a particular Fibonacci, but it's really when they cluster together. So I think this is just a good example of both of those. And then when you're looking at these charts, you really want to take a look, we're looking at gold, silver too, because silver is the more volatile of the two. And I apologize for so much going on in this chart, but I didn't know, I didn't realize we were going to be looking at these. I usually like to keep my charts a little bit cleaner, so excuse the mess, if you will. So here you have your downtrend line in silver. Let me just show you guys how awesome this is. I mean, look how beautiful this is. You have this, so when I talk about gold, you have your first low, your second low, your third low, and then I told you in gold, the fourth test will break. Here's just a good example of that. Silver on the 4th test broke. I hope you guys can see that. Are you guys able to see that okay, or are there too many lines distracting?
No, I think, JC, I think it looks just great. And, just looking at the charts, just a quick question that I know that I have. When you get a chance, maybe you could share with us some of the indicators that you've got there, because this is a very clean chart, but it looks like you may have some moving averages or something going on there. When you get a chance, if you could just explain those, that would be helpful.
Sure, and I apologize for having these because if I'm not, if there's a particular moving average that's not really helping us or worth discussing in this particular topic, I usually like to eliminate them. In this case, the dotted line is the 50 period moving average. I just want to reiterate periods because the market is fractal. We use a 50-day moving average on a daily chart, 50-week moving average on a weekly chart, etc. And then the straight line, if you will, or the undotted line, is the 200 period moving average. In this case, we're looking at a weekly chart, so it's a 200-week moving average. Down below, we have a 14-period RSI. In this case, we're looking at a weekly, so it's a 14-week RSI that, as you guys could see, was potentially a bullish divergence that broke down. And boy, when that happens, that's terrible. So, silver broke that support. And just to get a little bit closer here so you guys can really see what's going on here, silver is bouncing at exactly the 161.8% Fibonacci extension from that move, just like gold is. The exact same thing. The exact same thing. So I think I think this bounce is for real. We can maybe see even 18.5 potentially, but that overhead, that support that broke, in my opinion, will become overhead supply. Again, which is why I wanted to show you guys those slides at the beginning. This is what we call polarity. Like a magnet, opposite poles, former support should turn into resistance. And that's why, even though I think we get a rally from this 161.8% Fibonacci extension, I think you can fade that rally, which I mentioned on Fox yesterday. And I think eventually we go down to below 15 bucks, right? Below 15 bucks from this support back in early 2010, right? Former support, we should acknowledge that. And I think ultimately we head down there, and realistically we can get under 14 too. Wouldn't surprise me one bit. That would take us down to what we're, again, getting back to the Fibonacci clusters. I think it's really important to reiterate this right now. Notice the multiple Fibonacci clusters down here. You've got the 261.8% Fibonacci extension from the most recent move. The 161 has already been acknowledged, so we know the market's paying attention. So I think that once we crack, I think that 261.8 extension, should really come into play. And just to reiterate that we like the clusters, that 261.8% extension right around, the 1375 area also happens to be the 161.8% extension of last year's summer rally. In other words, the first bounce off of those crash lows last summer. So again, another very important level from Fibonacci standards, and they're clustering together. So although there is some support under 15 from the 2010 lows, man, those Fibonacci clusters are just staring at me, and I really think potentially, we could see that again, and we will continue to reevaluate. But that's what I see. Just taking a closer look here at silver, you can see that extension really coming into play here. I think any bounce that we get into this area, 18.5, 1840, I think it's probably a fade. So getting back to knowing your time frames, what are your individual time frames? If you're a short-term trader right now, do you want to be short gold and silver? I'd argue otherwise. If you want to be short gold and silver by fading strength from a more secular perspective, that I could get down with. So it really is, who are you? Why are you here? What are your objectives? What's your time frame? And I think it's different for everybody. So for me to say, short it, if I'm a day trader or a short-term trader, it's not something for me.
Up question there with regard to time frames, and the question's kind of directed specifically at you. So from that perspective, the question is for you, JC, what are the time frames that you like to trade the most? Are you basically looking to swing trade, over several days? Are you looking for, intraday moves in the market? What's your personal preference?
That's a fair question. So I'm not day trading. That's just not for me. It's not my style. 1 minute charts give me a headache, personally. Intraday charts for me, there's just way too much noise. I don't need to be doing that. That's really just not for me. Not that there's anything wrong with that. It's just we're all different. In addition, the multiple time frames, I trade based on the daily charts. Those are really that's how I make my decisions. But with that being said, I have to look at the weekly charts to get a better understanding of where we are from a structural standpoint. So although I do think gold and silver are going to have this bounce, we need to recognize that this comes within the context of a very strong bear market. I don't care what the gold bugs are telling you or what the perma bulls are telling you or the industrial uses of silver or whatever nonsense they're talking about these days. We need to look at price, and this is a bear market. I don't care who you are. Silver's down like 70% or something like that from the highs a few years ago. I mean, that is not a bull market. I don't care who you are. So I need to understand that although I think we get this bounce, it comes within the context of a bear market. But again, I trade based on the daily charts, so we anticipated this move. Our members received our commentary this weekend on commodities and currencies, and I said, hey, we got to be fading dollars here. There's just too much love for dollars. And it's just so funny watching sentiment. I mean, come on. They hated them in May when they needed to love them. Now they love them when I think they need to hate them. I mean, that's just human emotion. So because of that, we're essentially, it was time to be covering shorts in gold and silver tactically. Structurally, we don't have to, change our viewpoint. I'm still super bearish gold and silver, but tactically, in terms of positioning on a daily time frame, there was time for a bounce for a lot of reasons. The Fibonacci clusters, the measured moves, sentiment. There were a lot of reasons suggesting we were going to get a bounce, and sure enough, that's what we're seeing. I think it continues. I hope that
So
answers the
JC,
question.
when I think about your background and experience, it's abundantly clear to all of us that you're a consummate professional and very diverse in your approach. So for the kind of products and services and solutions that you provide, would you say that you are geared towards an intermediate to experienced trader, or do you have offerings or suggestions for working with people that are just new to trading, that are looking for some solid foundation and technique to build on?
I would say, I'm proud to say actually that we can really, our analysis can really be applied to anyone from a professional institution to a financial advisor to someone who trades at home and knows what they're doing to someone who doesn't know anything that they're doing. I really can say that, which is interesting. I hadn't really thought of it that way, but now that you mention it, so the reason I would say that is because and one of the things, the credit that I've gotten over the years is that I'm consistent with my approach. It doesn't change. So, when you say that, I'm diversified and I look at the market so many different ways, I really look at all markets the exact same way. I use my 14-period RSI, daily and weekly time frames. I use a 50 and 200-period moving average. I use my candlestick charts because they tell the best story. I use my line charts for my ratio analysis. I use a relative strength index on my ratio charts as well, when I'm comparing like in the Brazil, Germany one that we were looking at earlier. And from a sentiment perspective, even if I miss a move, right? So here's a good example. I missed the last week rally of the dollar because I was already fading it because of the sentiment. So I didn't really care to miss that, right? We were right. We nailed it. Call it a good trade. See ya. You can't be upset for being disciplined and, following your process. My process tells me, hey, we hit the resistance that we were looking for. Sentiment is obnoxiously bullish. Time to get out. Fine. So it went up another few days. We're going to be mad at ourselves. We can't do that. So, for someone who's new to the market, I think that consistency really adds a lot of value. The exact same approach to a Brazil ETF, to crude oil futures, to regional banks or technology, to a ratio chart, to interest rates, to the Dow Jones Industrial Average. It's really the exact same approach again and again and again and again. So someone new, I think it adds value. For like a financial advisor or something like that, getting a better understanding of what's happening in the markets, coming into the week to be able to speak to your clients from a intellectual level, and really for anybody who's trading assets or managing money of any kind. In my opinion, this isn't brain surgery, guys. Like, what we're doing is not rocket science. There's a lot smarter people out there than me. What I think that where my value really comes in is that I put in the work. I do the homework, right? So a lot of people aren't willing to do the homework. I'm looking at hundreds, if not thousands of charts on a regular basis and constantly updating them and constantly, trying to question my thesis and try to make arguments as to why my thesis might be wrong. So I think that that's really what adds a lot of value, is that I'm essentially doing the homework for you, where you don't have to sit there and rip through all these charts. And I'm already doing that. And why am I doing that? Because I'm doing it anyway. This is my job. This is what I'm doing. So the fact that I can now deliver this, to people all over the world that have been asking me for a few years, and guys, some of the emails I've been getting from some of our members, I mean, it brings like a tear to my eye. Some people are just so nice out there. So if I can help a new trader, and again, there's a message me application on site where you can send me emails if you have any questions, or want me to take a look at something. You can always message me, and typically I'll get back to you within 24 hours, usually less. So again, just to reiterate, anyone from someone new who's trying to learn, to a professional who does this for a living, that wants someone to do their homework, for them. I'm essentially letting you buy my homework. I wish, could have done that, when I was in elementary school.
Well, that's terrific. And once again, I just want to, taking a look at this special offer that you have here, could you go over this again for us here? Because I see the S&P, the global markets, etc. If you could just go over your offer a little bit again, just do a quick repeat here. I want to make sure that everybody fully understands what the deliverable is associated with this offer.
Sure. So before we get into that's a great point. So let me just show you guys something real quick. Here on eaglebassolutions.com, right? We have all of our products. Sorry about that, guys. We've got all of our products here, our currencies and commodities, which includes 16 commodities on multiple time frames, 10 currency crosses, including the dollar index, euro, yen, Aussie, pound, CAD. This is a great product for commodities and futures. One of my favorites to chart, just selfishly. I really like the uncorrelated nature of commodities and currencies that really have nothing to do with the S&P 500. For example, the S&P has been ripping for years, and some of these grains have just been getting slaughtered. Precious metals as well. Then we have a Dow 30 solution, which includes all 30 Dow components on multiple time frames, everything from Microsoft to Intel, Boeing, American Express, Goldman Sachs, etc. Again, multiple time frames, daily, weekly charts, and all of our members, all of these packages, they come once a week with all of this analysis. And then usually, a few paragraphs on some of the things that stand out that may have changed from the previous week. The global markets package includes all of the country ETFs from Europe, Asia Pacific, Latin America, Africa, Middle East. Again, like I said, everything from Japan and Malaysia to Canada to Chile, Brazil, Mexico, Peru, and a lot of relative strength analysis as well, which I think adds value. Then we have the S&P sectors, which are over 50 annotated charts on a weekly basis, which includes all the major sectors, financials, technology, like I said, biotech, etc. And then our package that comes once a week is the U.S. major market averages and interest rates, which includes the Dow, the NASDAQ 100, the S&P 500, which I think it really adds a lot of value to understand where we are from a structural perspective in the stock market, and then more tactically, how best to be positioned on multiple time frames. So this particular package offers the S&P sectors and subsectors for 12 months and the global markets ETF. So you're getting all of the U.S. ETFs, over 50 charts on a weekly basis, and all of the global markets ETFs, which are over 80 charts on a weekly basis, and you're getting this for the entire year. So you'll get multiple emails, and then random commentary. If I see something interesting, midweek, you'll get hey guys, heads up, look at India, or something like that, or hey guys, gold miners, I think there's a bottom. something like that, in addition to, what essentially you're paying for. And you're also getting, you can message me anytime. And then if for whatever reason you didn't receive an email or you can't log in or anything like that, God forbid, the guys in MarketFi, I've been friends with them for years. Jason Raznick and Kyle Bazzi, great guys. Their support staff over there, they really do a nice job. So I'm not the technology guy. I just look at charts. Like my grandmother says, my grandmother asked me, JC, what do you do for a living? I'm like, Grandma, I build puzzles and I answer emails. So that's what I do. So these guys take care of all the back end stuff for us, and they do a nice job. So that's really what the offer is, and I'm glad that I can extend it for you guys, because I think this one really adds a lot of value, because you're getting the domestic stuff and the global stuff too.
All right, that's terrific. I appreciate that summary there, because it does certainly sound like a terrific offer. Folks, we have about 10 more minutes left here, and once again, really do appreciate the time that JC has spent with us. Do you have any additional questions that you would like to have JC address? JC, I do see that there is a question here. One of the folks in the room says, do you use the MACD, or do you have an opinion on the MACD as an indicator in trading?
Sure, that's a great question. I actually get that question a lot. So when I'm looking at, so when you guys look at my charts, you guys see price up top, you got some moving averages and whatnot, and down below consistently you have a 14-period RSI. The reason is because that's what I use. We all know the oscillator junkie out there, right? The guy with 12 indicators below price. What are you doing with that? Like, were you waiting for all of them to tell you to buy or all of them to tell you to sell? That's never going to happen. So what do they call it? Paralysis by analysis, or whatever it is. So, when it comes to momentum, MACD is a momentum oscillator. RSI is a momentum oscillator. ROC, rate of change. So there are various momentum indicators that you can use. I'm not telling you that one is better than another. There are a lot of different indicators that you can use in different ways. But again, getting back to who are you, and know who you are and know what you're good at. I've been using a 14-period RSI for a long, long time. So I know the way it behaves. Me and RSI, we just get along well. MACD, there's nothing wrong with it. It's just not what I use. I prefer to use RSI. So for me, that I'm not an oscillator junkie, I just pick one instead of having multiple momentum indicators. The one that I pick is RSI, 14-period. That's just me. I know a lot of people that use MACD, really smart people actually. Some of the smartest guys I know in the business, and they use MACD. So again, doesn't make one better than another. It's just the one that I use. So I hope that answers the question.
Yep, I think that covers it well, folks. A couple more minutes here. Let's see here. So a question here: which MVA gives a good buy-sell divide?
What is MVA?
That would be, I'm assuming MVA would be moving average. If the person, Zaki, if you could go ahead and restate that. Are you saying which of the MVAs, moving averages, gives a good buy-sell divide? Just want to make sure we understand your question appropriately. And once again, I just want to say, JC, I really do appreciate, the fact that we've been ad hoc for the past 30 minutes or so, because I think we all see a lot of value in you just going right to your charts. No need to apologize for what they look at. We all understand. And I was just, very, very impressed with how clean everything looked there, and for you taking the time to explain those. And yeah, what Zaki meant was moving average. So the question here is, which moving average, in your opinion, gives you a good buy-sell divide?
I would imagine by buy-sell divide, I mean, you're saying that which moving average helps you trigger a buy signal or a sell signal. I guess that's what is being asked. I'll go with that, but I don't use moving averages for buy and sell signals at all. I actually use moving averages for trend recognition. So in other words, if we're looking at, let's give some good examples. So if we're looking at something that has a rising, let's not do that. So in this case, what's a good example? You know what a good example is? Brazil is a great example. Here's Brazil on its own. Sorry about that, guys. We're having some technical difficulties. Here we go. So here's Brazil. Excuse these lines. Sorry, guys. You know, I love my charts clean. I know you said it's okay, but it really annoys me. So, you know, here's a 200-week moving average. And you know, I yesterday that 50 period moving averages annoy me because, truthfully, they just really add some noise. I really should start taking these out a little bit more. But I use these moving averages really to recognize trends. We have a downward sloping 200-week moving average. So if we have a downward sloping 200-week moving average, in all likelihood, we're probably not in an uptrend, right, from a secular perspective. Now, if we have prices above a rising 200-week moving average, which is precisely what we have in the S&P 500, let me just get a little closer. Guys, we're above rising 200-week and 50-week moving averages. Guess what? We're in an uptrend, right? Again, not a shocker. We all know what the S&P 500 is doing, but this is just a good example of, you know, that trend recognition. Let's look at something that's been in a downtrend. Let's look at gold miners. I mean, what a disaster. Shocking, downward sloping 200-week moving average. Let's look at a trendless market. Let's look at crude oil. Crude oil, sure enough, a flat 200-week moving average. If you look at a daily time frame, here's a daily time frame crude oil, flat 200-week moving average. So when you talk about hot messes, you know, flat moving average, 200-week moving averages, I mean, they're just a headache waiting to happen. I mean, I'm telling you right now, you know, if you don't want a headache, don't trade assets that have flat 200-week moving averages if you're looking at it from a secular perspective. If you're looking at a daily chart, a 200-day moving average, you know, don't do that. You know, it's literally a headache waiting to happen when it's flat. If you're trying to buy a stock and you're looking for a mean reversion, if a stock or any asset class for that matter, we'll just use stock for example, if a stock is substantially below a rising 200-day or a rising 200-week, depending on your time frame, in all likelihood, you're going to be right on that mean reversion. But if you have downward sloping moving averages and you're hoping for a reversion, it might not come. But it's very difficult for markets to really crash when you have upward sloping 200-week moving averages and 200-day moving averages. Very, very rare. Same thing on the other side. When you have downward slope and stuff, you know, and prices are substantially above that, you know, fade that. You know, I'd fade it, you know, just because you're fighting the primary trend. I think it was the great Ralph Acampora, you know, who always reiterates, don't fight the primary trend. And I think that the 200 period moving average really helps you define the direction of that primary trend. And I like to be in that. I like to be in that direction. You know, when you're swimming, don't you want to be swimming with the tide, or do you want to be swimming against the tide? Right? A lot of people are always trying to fight primary trends. You know, I like to be. I like to make my life easy.
And so as we're winding down here, one last question here for you, JC, and that is, you know, do you use indicators? And if so, which ones do you use to help you determine when you want to get in and out of a trade as a swing trader? You know, what are some of the things that you look for to basically, you know, target those entry and exit points?
Sure, and I just to answer Steve's question real quick. Yeah, I use Thinkorswim. I like it. It's clean, simple. Their customer service is great. Their coders, if I need them to build something, they'll do that. So they're great. Yeah, I've been using them for years. So for indicators, yep. So like I said, I use a 14 period RSI. I like to, like I said, on a daily time frame, weekly time frame, I'm always using a 14 period. So it's just what I use. I like to use a 50 and a 200 period moving average. Mostly the 200 for you know, primary trend recognition. I use a lot of pattern recognition too. You know, I'm old school Edwards and McGee guy. You know, looking at patterns. You know, flags, pennants, symmetrical triangles, ascending triangles, double tops, double bottoms. You know, all of these things. So from pattern recognition standpoint, absolutely, I'm old school like that. I use Fibonacci for a lot of reasons. I use Fibonacci for retracement analysis. So if we're in a big bull market and now we're correcting, you know, a lot of times we'll correct to that Fibonacci retracement, whether it be a 38.2% retracement or a 61.8. You know, that's really what I use for retracement. For my extensions, I like to use a 1.618% Fibonacci extension, so that when, let's just say we have a rally and then a correction and then we break out above the previous high, I like to use that 161.8% extension of the previous move, you know, for essentially targets and, you know, places to take profits or whatever the case may be, or to manage risk for that matter, especially when they cluster together with other indicators like support and resistance, which obviously that's where it all starts, guys. Like, all this stuff is great, but that's really where it all starts. And, you know, just want to reiterate before I leave, you know, the importance of risk management. You know, when I do these webinars, a lot of times I get asked, JC, you know, you have one piece of advice for anybody who's listening out there, whether they're new or old or whatever the case may be. Guys, all this is great, and everything I showed you with the sentiment and the moving averages and Fibonacci, Intermarket, I mean, all that's fantastic. But at the end of the day, it all comes down to managing risk. That's the only thing that matters, is defining what your risk is. If we're entering a position and I can't tell you at what price my thesis is wrong, I can't position myself in that. In other words, if that risk cannot be defined, it is impossible to calculate what the risk versus reward ratio is. And if I can't calculate what the risk versus reward ratio is, how do I know if the risk versus reward fits my parameters? So again, risk management is the most important thing here. We're not economists. We're not analysts. We're not journalists. We don't get paid to be right. In fact, the market, in the history of capital markets, no one has ever been paid to be right, ever, or to know the reason why. We get paid to manage risk and be in the right positions where, you know, we can manage our risk, and that's really the only thing that matters. No egos. It's not about being right. It's about making money. So don't worry about why. Analyze price, manage risk, and I think you're way ahead of the game, ahead of everybody else.